This is an interesting topic. Accounting for long-term contracts, the revenue recognition aspects especially. Some contracts will take more than a year to complete. If your business model is, for example, building buildings or airplanes or ships or even large software projects. The question becomes, when it's a long-term contract, is this a series of hundreds of performance obligations? So, for example, when you build a building, is it a performance obligation when you install the air conditioner and when every door, is that a performance obligation? Many such contracts are a conglomeration of many goods and many tasks. They're only fully functional for the customer in their final form. In that case, a single large performance obligation exists. Let's show you some examples. When American Airlines contracts to have Boeing build a plane, American Airlines has no use for the airplane engine absent the plane it is buying that the engine will power. When Express Scripts built the building here in our area, it had no particular use for the huge air conditioner absent the building it is being purchased to cool. These assets are of no value distinct from the good they will be part of. Hence, that's the reason for a single large performance obligation. Next question. When is the performance obligation satisfied in these large construction contracts, these large manufacturing contracts, these long-term contracts? Should a builder or construction company just recognize the revenue from a $1 billion building or a $10 million road construction when it is fully complete? Should Boeing just recognize revenue when the customer flies the finished plane from the assembly plant at the airport? Is that when their performance obligation is satisfied? Now, in both of these cases, it's certainly when the performance obligation is fully satisfied. But from a revenue recognition standpoint, the answer is it depends. Most long-term contracts will actually qualify for revenue recognition over time. That'll be the case that you can recognize revenue over time if the customer owns the seller's work in process. So, for example, the company we're accounting for has a home remodeler and they're building a new wing on the home, a new den. Well, the builder can't carry the den to another client, so the customer owns the seller's work as it's in process. That contract would qualify for revenue recognition over time. Or if the asset is customized to the customer's desires, that contract will qualify for revenue recognition over time. Or if the seller has no alternative use for the asset and the seller has the right to receive payment for progress even if the customer cancels the contract. If both of those are true, the contract will qualify for revenue recognition over time. If none of those are true, we simply recognize revenue at the end of the contract when it's fully done. Hence, the performance obligation is satisfied only at the end. Now, we will do a comprehensive case on a long-term building construction contract upcoming in the next video. But let me first introduce the accounts that arise associated with the accounting for long-term contracts. Oh, and by the way, in our upcoming case, we will do the accounting for one that qualifies for revenue recognition over time and one that does not. So let's turn our attention to accounts associated with a long-term contract. Here's the balance sheet accounts. The first balance sheet account that you're going to see is construction in progress. This account is increased via a debit when costs associated with the project are incurred and put into the asset, put into the project, put into the contract, put into the deliverable good. It's akin to an inventory work in process account. It's inventory in process under the long-term contract. That's construction in process or construction in progress. The other balance sheet account is billings on construction contract. This is a contra construction in process account. I'll explain that again in a second. At the end of each period, these two balances are actually netted. Hence, I wrote this note here that the net asset reported on the balance sheet is construction in process, construction in progress, either one, in excess of billings. I'll talk about the logic for that. Now, if that net amount, construction in process, in excess of billings on construction contract, if that net amount is a debit, the net is reported as a contract asset. Construction in process in excess of billings, which is essentially a future accounts receivable. We just haven't billed on what we've already built, we haven't billed what we've already built. If the net amount is a credit, the net is reported as a contract liability, one line on the balance sheet related to the contract. You can call it billings in excess of construction in progress. And it's essentially an unearned revenue account because we've billed, but we actually haven't done that much work yet. Boy, we owe that for sure. So the logic for this, if we put the full construction in process physical inventory asset on the balance sheet, and we put the cash the customer's already paid in cash or accounts receivable, we would be double counting the same asset. Think about that. Take a second, pause if you have to, and go back to the book, read about that, think about that, repeat my words, make sure that makes sense. Let's turn our attention to the income statement accounts related to long-term contracts. The first one is revenue from long-term construction contract. It's a revenue account. It's the contract revenue recognized in any particular year. Of course, if the contract does not qualify for revenue recognition periodically during the project, then revenue from long-term construction contract is simply recorded for the entire amount of the contract upon completion of the contract. Now, if the contract does qualify for revenue recognition during the contract completion process, then the amount of revenue recognized will be a portion of the total contracted revenue value, the total price of the project, based on some logical measure of progress towards completion. We'll see an example of a logical measure of progress towards completion in our upcoming case. The other account on the income statement you'll see related to a long-term construction contract is the cost of construction. It's the cost of goods sold for a construction contract. It's the total of amounts added to the construction in process account this year. It's the salaries paid to our workers and the wages paid to our workers. It's the materials used and any other costs that go in there. That'll be the cost of construction in the current year. And so obviously, look at that. You have basically gross profit. Revenues from construction contract this year, less cost of the construction this year, where the cost of construction is the additional amounts put in the construction and process account this year. Let's see a summary of this. For the balance sheet, remember that The one line you'll see is construction in process in excess of billings, or billings in excess of construction in process, if that's the case. And then I wrote the notes again that I discussed in the last set of in the last discussion on the previous note page. For the income statement, you're going to see under revenues earned on the long-term contract this year, less the cost of construction this year, is the gross profit on long-term construction contract this year. So the revenues earned this year based on progress completion calculation. We'll see an example of that. The cost of construction includes the salaries and the wages of those working on the project this year and materials used on the project this year. Okay, that is the process in general. That's an introduction. Now we will do a case. I'll see you in that video. Thank you for your attention. And again, feel free to return to this video and return to the book. This is a rigorous topic for sure.